So you have a major expense coming up. It could be any number of things, a renovation to your home, maybe something broke, you need to fix that. Is pulling money out of your home through a home equity line of credit the best way to do that? Is it a good option? We'll tell you about that coming up here on this episode. Welcome in to the Smart Mortgage Show. Glad to have you here on our YouTube channel. If you're watching there, if you're listening, thanks for listening wherever that might be. We always cover a wide range of mortgage lending and different questions and concerns that come up quite a bit with Bill over at Cross Country Mortgage. He is a regional president. And today, Bill, I want to talk about the home equity line of credit. And I think a lot of people probably have a decent amount of equity, right? They're just kind of staying in their home. They don't want to leave because of the interest rate they have. So it comes up quite a bit probably. Is this a good idea in terms of trying to fund big expenses? So I want to explore that with you today. So as we jump into this, just kind of lay out what the home equity line of credit is, how that works, what exactly that product does for someone.
Yeah, Ben, so a home equity line of credit, easiest explanation is it's just like a big credit card that's tied to your house. So because it's tied to, real property or collateral, the rates are a lot lower than credit cards. But it works like a credit card where you can run it up and pay it down and run it up and pay it down. And it usually allows you to do that for a period of, say, 5 or 10 years where you can run it up and, draw on it and pay it down. It is usually an adjustable rate. So the rates are tied to the federal funds rate or the Wall Street Journal prime rate. Rates on those right now are like close to 9%. And that's basically how they function. A little bit different than like a home equity loan, which is like a car loan where they give you all the money at once and then you pay exact payments of installments every month until it's paid in full, principal and interest. Home equity line of credit only requires you to pay the interest for the draw period. And then once the draw period's over, let's say it's a 30-year loan, the draw period is 10 years. So after the draw period's done, you can't take any more money out of it, and it's going to require you to pay it in full, principal and interest, for the next 20 years. Okay.
It's a good explanation. So talk about a home equity line as it relates to big purchases. Now, this could be anything. It could be something that pops up like a medical expense. It could just be you want to buy a new car. It could be a home upgrade that you want to fund. Does it make sense to take a home equity line out to pay for these things?
So first, I would start here and say, for most people, I think it's a great idea. I've always had a home equity loan, and it's a great thing to have if you need it. I think that sometimes people, by the time their back's against the wall, they might not qualify for it. So you want to put it in place while everything's fine. And it's just a great backup for, like you said, big purchases. It's a great backup for unexpected expenses. It's a great backup for, a whole multitude of reasons. But you want to be careful and not use your house as a piggy bank. So if you're dipping into it month over month for just normal expenses, then your budget's off. And you need to find a place to cut otherwise, because although you're allowed to use your line of credit that way, I don't think that it is the best practice to do that. So I feel like it's good for big purchases. And I also think you need a plan to pay it down more quickly than over the 30 years because the rate's not fixed. Now, we don't expect rates to skyrocket, but nobody has a crystal ball. If rates go up dramatically in the next couple of years, now your payment's going to go up dramatically. And if you don't have a plan to pay it down quick, it could put your payments out of budget and cause all sorts of problems.
So a lot of times with financial decisions, it comes down to discipline, right? If you're disciplined enough to pay that off and can manage that money, it could make a lot of sense to use that. So a couple follow-up questions, because I'm curious personally. I don't have a home equity line, and I've considered it. Because that rate's adjustable, it doesn't really matter when you take it out, right? Obviously it does maybe by your qualifications, but in terms of the rate that you're getting and what what it's going to cost you, it doesn't really make a difference. Is that correct?
So let's just go one step deeper. We have a home equity product that has what's called a fixed rate partition, which means let's say you had a $100,000 potential line and you pull out 10 grand, that 10 grand gets fixed at today's market rate. Okay. So if rates go down, you're still fixed up higher. It offers security, but the rate doesn't come down with the market. Now, there are home equity lines that just fluctuate with the market no matter how much you have outstanding. There's no fixed component to it in any way, shape, or form. But I would say, to answer your question, I don't think it matters when you get it, because you're going to be subject to market fluctuations even with the loan that has the fixed rate partition, because it's going to fix in what's available or what the rate is at that time. So to your point, does not matter when you get it.
I guess I kind of asked him because if people say, well, I should have gotten the home equity line 3 years ago when mortgage rates were, 3% and interest for the home equity is probably not much higher. But even you're saying, even at that point, even if you would have opened up one then, your rate probably would have increased by now anyway.
That's exactly right. If you opened it 5 years ago or today, you're pretty much going to have the same rate because now it's adjusted to current market.
That's interesting. Good to know. And for anyone, I know that you mentioned you have that product at Cross Country Mortgage. The other kind of thing that I'm unsure about is if I'm saying, okay, I want to do this and I don't have my mortgage through Cross Country, can I come to you for the home equity line, or is this something you have to take out with the company that you work with for your mortgage? So
you could actually go to anybody, regardless of who holds or services your first mortgage. You can go to anybody for the home equity.
Very good.
Yeah, and one other piece to the home equity that's very important. There are banks that make the process of getting a home equity loan really, really painful. So when I talk to my clients and I've got all their information and I know what their needs are, I'm looking at, we have 20 different investors that we target for them. And based on their needs, I'm trying to find, well, what's the best terms and the best product, but also the easiest process. Because there are banks that, we hear it time and time again, and they just say I would never go through that again. Yeah, it can be a challenge. I think that's why a lot of people just don't bother looking into things like this because they are worried about the hassle that's involved. So kind of quickly take us to that process, Bill. Anyone that's looking for a home equity line of credit, maybe want to take up this opportunity to purchase or upgrade their home. What do they need to know? What do they need to have in place when they speak with you? So the first conversation is really straightforward. The questions that we'll ask are going to be things that they already know. So I think that you don't need to be, you could be driving down the road on the way home from work, and anything you don't know that we need, I'll follow up with an email and a list, but it's very basic. How much do you owe on your house roughly? How much is your house worth roughly? Then it helps me understand how much equity you have, and then roughly how much do you need to borrow? And then we fine tune from there to kind of dial it all in. Awesome. Again, 484-352-4151 is the number to get in touch with Cross Country, or you can log on to smartmortgageshow.com. So to answer the question, home equity line could be a good option for you to borrow money. Obviously, you want to have that conversation with your bigger financial picture, but a good place to start is by getting in touch with Cross Country. Can help you at least discuss options with you, what it might look like, and what it could mean for you. But a good option potentially out there. So again, 484-352-4151 to get in touch with Bill over at Cross Country. Bill, thanks for the time and the breakdown on this topic, as you always do. Very insightful, and we appreciate it. Yeah, my pleasure. Reach out anytime. We're always happy to discuss and see how we can help. This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Cross Country Mortgage, NMLS number 147060.